Hello, my name is Jared Schiller. Welcome to our first in a series of videos designed to help in financial planning. Today's video will address major concepts related to general financial planning. Let me introduce my associate, Andrew O'Doherty.
Thanks, Jared. Again, my name is Andrew O'Doherty. I entered financial services after retiring from a long and rewarding career in education. In the next videos, we'll talk about building the foundation, where you'll envision the retirement you want and how you'll finance it based on current and future retirement trends and strategies. Then we'll discuss creating and protecting wealth, examining how you may accumulate assets during your working years. Then we'll talk about establishing your income stream in retirement. Building on what you've learned so far, that presentation will discuss how to prepare before retirement to provide the income you need during retirement. And finally, we'll talk about making the most of what you have. In preparing for retirement, it's important to anticipate what retirement looks like. How much are you going to need to sustain the lifestyle that you have now? Most advisors suggest that we need 80 to 90% of our pre-retirement or current income to cover expenses and sustain the lifestyle and retirement that we have now. Income needs change over the different phases of retirement. At the beginning of retirement, most people's monthly income exceed their expenses, while after a decade or so, expenses begin to exceed monthly income. On average, 20% of retirees' income will be spent on health care. It's important for us to look at this in terms of phases and prepare for those fluctuations and added expenses. We hope to empower you through this presentation to know which questions to ask, which concepts to consider as you prepare for retirement. First, let me start with the idea that it's important to save. It isn't how much you save as much as it's important to start saving, getting into the habit of saving. It isn't important as to how much you save as to where you save it. But saving and planning are really critical in getting started.
One of the major understandings we need in beginning to plan is how compounding interest works. Compounding interest is the idea of earning interest on interest, which allows our money to grow exponentially. As you can see in this graph, we've taken $250 per month and compounded it over 40 years at an 8% interest rate. As you can see, at the end of that term, we have nearly $900,000 as a result of our efforts. This concept is critical as we begin to look at products and strategies we'll talk about later in this presentation.
Compounding interest is characteristic of most retirement savings vehicles, but it's an important concept to understand. Most financial planning for retirement involves three phases: accumulation, conservation, and distribution. The accumulation phase is where we work to save as much money as we can, and I think most of us find ourselves in that place now. As we approach retirement, we have another set of decisions to make. That's how to protect our savings and keep it available to us as we enter into the distribution phase. When we reach the distribution phase, there are a whole other set of decisions that we have to make. These decisions involve how much money should we take from our savings in order to sustain our retirement income over a lifetime. The decisions involve questions about how we're going to protect our money from volatility, taxation, and other eroding factors.
The next major point to understand is the impact of eroding factors and the importance of designing a strategy to offset them. As you can see in this slide, we've laid out several of those eroding factors, stock market volatility and taxes being two we'll talk about more in a minute, but another to understand is inflation. Inflation is the loss of purchasing power that occurs over time. Historically, the rate of inflation has been around 4%. Thus, to even stay even, you have to earn at least 4% in your funds.
Taxes are another major consideration in retirement planning. Most savings vehicles fall into three categories. They're either tax-free, tax-deferred, or taxable. Those ideas must be taken into account as we choose strategies and vehicles. This slide shows the historical fluctuations in the tax rates. And if you look at where we are now, you can see the taxes are as low as they've ever been. It's not likely that taxes can remain this low given the national debt and the government programs in which we're involved. So it's important for you to consider how you save, because if you save in a tax-deferred vehicle, for example, you're simply postponing paying taxes in a likely higher tax rate environment.
These graphs demonstrate the recent volatility that the market has undergone over the last 5 and 10 years. It's likely that these trends will continue. This is important because you didn't want to be having to withdraw your money when you're not sure where the market is going to be.
Volatility is a really important understanding to have. Most financial professionals, and particularly those in the securities industry, will tell you that the market has grown an average of 11% since the 1930s. This is true, but that's over the whole long span. It does not take into account these shorter segments that our graphs show.
In addition to understanding the concept of rates of return as it relates to markets, it's also important to understand the concept of rate of return as it relates to products. Many financial professionals and companies will put their best foot forward when it comes to portraying numbers in their ads. This scenario will show you the reality of average rate of return and how that differs from the philosophy of compounding interest. Consider this scenario. Here we have a 4-year projection with markets going up 100% and down 50% every other year. If we average that rate of return, we have a phenomenal 25% rate of return. But wait, let's take a look at how this scenario compares with real dollars. So if we take that same market outlook over those 4 years and put a $10,000 starting balance to that, you'll see that at the end of 4 years, we're literally back where we started. In fact, after fees and sales charges, we've likely lost money. Part of what makes retirement planning so complicated are the numbers of vehicles or ways to save that are out there. In the next few slides, we're going to examine each of these vehicles in terms of security and stability, potential for growth, liquidity, and tax implications. In the slides, the characteristics that the product has will be in black, and those that it lacks will be in red. The first group of products that we're going to look at involves security. This is cash, savings accounts, CDs, bonds, metals, and other types of products designed to conserve assets. The first couple of products we'll look at are cash and savings and checking accounts, which are correlated to cash. As you can see, they experience predictable financial results, but you don't really get a competitive rate of return, you can't borrow against them, and the interest that you earn, especially in your checking and savings accounts, are going to be taxable. Certificates of deposit and bonds are debt instruments that earn a current interest rate, but unlike cash in savings accounts or checking accounts, you lose the liquidity in that your money is tied up for a given term. Usually there are significant penalties to withdraw your money prior to that term. Also, like with savings and checking accounts, the interest that you do accrue is taxable in the year it was earned. Precious metals such as gold and silver, like cash, offer a degree of security, but unlike cash, are susceptible to the markets in which they trade. As you can see, there's no guaranteed loan option and no tax advantage to holding these metals.
Term life insurance is another product that assures some degree of security. It doesn't generate income, it doesn't earn, it is tax neutral except in terms of the death benefit, which comes out tax-free. Its major use is to protect or replace income that might be lost to the death of one of the members of the family. Fixed and indexed annuities. What is an annuity? An annuity is basically insurance against living too long, because it provides an income stream that can be continued for life. There are different types of annuities that can be purchased. Historically, the fixed annuity has been the backbone for providing a lifetime income. It offers a guaranteed interest rate, typically lower, but also guarantees income for your lifetime. The chief characteristic of the fixed annuity is safety. In the 60s, many weren't satisfied with the low interest rates that fixed annuities offered. Insurance companies then came to design variable annuities. These variable annuities were rooted in mutual funds and therefore participate in the market, as opposed to fixed annuities provides a potential for significant growth. However, by virtue of being in the market, there's also the potential for loss. So the question that faces us in looking at these two products, fixed or variable annuity, is whether we want safety or growth. In response to that frustration, the major insurance companies now move to design what they call index products. Both in annuities and in life insurance, what they try to do is combine the best elements of both fixed and variable annuities so that we could provide growth with safety. Being indexed means that the money is not in the market. It follows the market trends, allowing you to capture market gains, but never put your principal at risk or your earnings at risk.
In this graph, you see the index products versus the S&P products over the period of time from 2002 to 2011. The index products, the blue line, as you can see, is far more stable and grows to $136,000 with an initial investment of $100,000. The S&P experiences much more volatility and only grows to $126,000 with that initial $100,000 investment.
This slide is an excellent description of how index product work versus the S&P. It's clear that the index product does not take a loss or share in the losses in the market. It doesn't earn as much as the S&P might offer, but you never lose your principal or your earnings.
Another conservative type of investment holding is preferred stock. Preferred stock is an equity interest in a company, but it operates a lot like debt in that it pays a current interest rate. But unlike bonds and other types of debt, you're subject to the risk of the volatility that comes with the common stock of that corporation. The products we will discuss next are designed specifically for the purpose of growth. They are generally in the market, and consequently many are subject to market risk. These include products such as common stocks, equity mutual funds, and others that we will get into. Buying common stock is buying direct fractional interest in a company. Unlike other vehicles, you are subject to the viability of the company in which you're invested, and there are no immediate tax benefits. Like common stock, equity mutual funds are companies that buy into a variety of companies in order to diversify their portfolio and make them less subject to risk. With common stocks as well as equity mutual funds, there's no loan against the holdings in which you have, no predictability in terms of financial results, and there's no tax benefits, as any gains realized as a result of sale of that stock is immediately taxed. Exchange-traded funds, or ETFs, operate a lot like mutual funds, except their specific purpose is to follow markets. So if the market goes up, the ETF will go up. If the market goes down, your holdings in the ETF will go down as well. Investment money is typically divided into two categories: qualified money and non-qualified money. Qualified money is pre-tax money used to buy into investment vehicles, whereas non-qualified money is after-tax money used to buy into investment vehicles. Qualified plans are the ones we're all pretty commonly familiar with in terms of 401ks, IRAs, etc. These allow you to invest pre-tax money and to grow that money tax-deferred. Because qualified plan money is in the market, you are subject to market volatility. And because it's government regulated, there are restrictions on when you can take your money out, how long you can leave your money in, and the amounts of money that you can put into qualified plans. Investments in real estate, like other investments in market-based tools, are subject to the volatility of the real estate market. Rapid gains can be made, as well as rapid losses. Real estate is also subject to some specific tax advantages in terms of the ability to write off mortgage interest. Liquidity in real estate holdings can also be compromised by market conditions.
Whole life insurance is another vehicle for saving for retirement. It provides some distinct features from what we described earlier in term life insurance, in that this type of insurance allows you to grow cash values. Those cash values become available to you in the form of loans as you get into the policy, and those loans come out tax-free. So it's an excellent source of supplemental tax-free retirement income. It also shares a characteristic with term life insurance in that the death benefit is tax-free. So it becomes a safe, predictable, growth-oriented vehicle for saving for retirement that's very tax-friendly. We've now covered what growth products look like and what safe products look like. The decision for you is to decide your own risk tolerance, how you want to save money, again, looking at tax issues, liquidity, safety. So those are the main concepts that you need to have in place to make good decisions about what vehicles you want to choose in saving for retirement. We've discussed those varieties of vehicles that are used for saving for retirement, and now what we want to talk about are the types of qualified plans that most people have. In fact, what's being phased out, if you would, of the retirement scenario are pensions. If you have a pension, depending on when you began working with your company, you have a guaranteed income for life out of that. But most companies now are transitioning to what's called defined contribution plans, where you contribute and build your own retirement pension, if you would. The major way of doing this is in a pre-tax plan such as a 401k. A 403b is used in a lot of school districts or for employees in education. But you have these two basic types of qualified plans: a pension, which is a defined benefit plan, and most of you will probably never see something like that. What you are faced with having is a defined contribution plans where you're in charge of your savings and how much you're going to have saved toward retirement. Many employers offer a 401k plan, and they offer a match along with that. Your number one line of savings in this situation should be to be sure to capture the match, because the match is free money. There are limits to how much you can save in a 401k plan. The amount for this year is $17,000, and there's an opportunity for catch-up if you're over age 50. But again, like other qualified plans, there are these contribution restrictions. If you're in an IRA, the amount is $5,000 with a $1,000 catch-up if you're over 50. So you need to be aware of the plan limits on all these qualified plans. In July of this year, of 2012, the government has imposed some regulations on 401k providers. That is, now they have to disclose the amount of fees that are impacting your savings. That's a very important concept to keep in mind as you put money into that savings vehicle, the 401k.
Many of the products have fees, but these new regulations were put in place so consumers could be aware of fees and to avoid excessive fees. The impact that these fees can have on your assets can be significant. There are typically two types of fees. You have asset-based fees, which cover management fees, which go to mutual fund managers in terms of covering their costs to reallocate assets within the fund, and administrative fees. These are fees that cover the cost of just doing business. The following example will show the impact that fees can have on mutual fund growth. In our first example, we have a mutual fund that has no sales load and no fund fees. As you can see, with market growth averaging 8%, at the end of year 3, our initial $10,000 asset has grown to $12,594. In the next slide, we take the same 3-year outlook, but we've got a sales charge of $500 initially, and then 3 years of fees that are $207 in year 1, $215 in year 2, and $230 proportional with the growth of the assets. The impact has been significant, though. It has reduced our actual rate of return to only 4%, or $11,261. You're probably asking yourself, which product is right for me? Well, unfortunately, there's no easy answer to this question, as like a fingerprint, every financial situation is unique and demands its own unique solution and blend of products. What we can offer are the following elements that will keep you on the right track. The first is discipline. Save your money, reduce payments to others. Protect yourself against taxes, market fluctuations, inflation, and unnecessary interest rates. Be prepared for unforeseen events such as an illness, a death, or other type of financial hardship. Ensure that your products are accumulating cash at a competitive rate of return, and avoid paying penalties to access your money.
We hope this presentation has been of help to you. We've tried to share with you the major concepts that you should be aware of. You need to really be clear about your own risk tolerance, how you want to save, making sure you can save, capturing any match offered in a 401k plan, be sensitive to taxes, fees, how and when you want to pay taxes, be aware of the phases of your financial life cycle so that you're very conscious about how you want to plan. A financial advisor can help with all of this by bringing the questions to you, by suggesting latest strategies or insights into how you might save. So take advantage of another set of eyes to look at your plan. Thanks very much for your attention.